Amazon just raised $25 billion, and they got $62 billion in demand. That sounds like a blowout. It's not. The same bank that sold that deal is simultaneously telling its clients to hedge against it. And that $62 billion number is exactly half what this same deal drew 90 days ago. If you don't understand what that delta means, you'll read this headline as bullish, buy the dip in AI names, and get run over by the one credit signal that's been right all year long. By the end of this video, you'll know exactly why $62 billion is the bad news, what Goldman's double book tells you about where this credit cycle is, and the structural mismatch that makes this raise different from every other one Amazon has done. Amazon is the most credit-worthy corporate borrower on the planet. So when they raise $25 billion and pull $62 billion in orders, your first instinct is, that's fine. The market endorsed it. Move on. Don't move on. In March, Amazon raised $37 billion and got $124 billion in orders. That's roughly 4 times coverage, right at the investment-grade industry average. In July, they raised $25 billion and got $62 billion in orders. That's barely 2.5 times coverage. Industry average is 4x. This came in below the floor. You'd expect the safest borrower in the world to get the most demand. The demand just got cut in half in 90 days. And here's what makes that worse. Global AI debt issuance has hit $335 billion in 2026, more than double 2025 levels. Amazon alone has raised over $100 billion in bonds in the past 12 months. Supply doubled. The buyer base didn't. The market isn't skipping this deal because they don't know who Amazon is. They're skipping it because they've already bought all they want to buy. Credit markets are pricing AI CapEx saturation before the equity market even smells it. The delta, $124 billion down to $62 billion. That's the signal. But here's what makes this more than a supply story. One bank is on both sides of this trade at the same time, and it's not a small bank. Goldman Sachs is a lead underwriter on this deal. Their job is to place the paper, price it well, and make Amazon look attractive to buyers. That's the business. At the same time Goldman is selling this paper, Goldman is telling its own clients to hedge against AI credit risk. Their language? Credit markets are at generational tights. Spreads compress to multi-decade lows. The only direction from here is wider, and wider spreads mean bond prices fall. You'd expect the underwriter to be bullish on what they're selling. Goldman is collecting the fee on one desk and recommending protection on the other. This isn't illegal. It's standard institutional practice, but it's a directional signal, and we've seen this sequence before. When CLO underwriters started buying protection in 2008, spreads blew out within 6 months. When energy high-yield desks hedged their own books in 2015, the sector repriced 40% lower. In 2022, leveraged loan arrangers flagged downside risks. They were right. Goldman isn't hiding this, which means the institutional smart money is already on the other side. Goldman's hedge advisory is the only honest price signal coming out of this deal. They close the deal, collect the fees, and the clients who bought the hedge collect the gains when the spreads widen. That's the double book. We don't need to model what happens next. Oracle already ran this exact script last month. As recently as early June 2026, Oracle had one of the cleanest AI narratives in tech. Stocks near all-time highs, consensus long, no obvious reversal catalyst on the horizon. Oracle lost roughly 50% from its June 2nd highs in 1 month. It returned to 2026 lows. There were no catastrophic earnings misses. The narrative simply repriced. And notice the sequence. Tech bonds weakened in secondary markets the moment Amazon announced the July offering. Before equities moved, the bond market moved first. Now add what Amazon just told its underwriters. No additional debt in 2026. That's it. Window closed. They've got a $200 billion CapEx budget this year, and they've raised what they can raise. The rest has to come from operating cash flow. Meanwhile, the entire complex is hitting the capital markets simultaneously. Alphabet is running an $85 billion equity raise. Meta just issued $25 billion in bonds. Amazon, Alphabet, Microsoft, Meta, their combined AI outlays will exceed $700 billion in 2026. Every name in the complex is funding at once into a buyer base that's already full. You'd expect a credit event to need a bad earnings miss to trigger it. Oracle didn't miss. Supply saturation is enough. Oracle isn't isolated. It's the preview. Bond demand weakens first. Spreads widen. Equity multiples compress. Then you get the Oracle chart. Amazon is one step behind Oracle in that sequence right now. But there's one more layer, and it's the one that makes this structurally different from every prior AI capital raise. Amazon just issued a bond that matures in 2066. Amazon's largest tranche in this deal is a 40-year note, maturing in 2066, and they priced it at roughly 1.25 percentage points above treasuries. On paper, that looks like the market is expressing long-term confidence in Amazon's cash flows. They're borrowing 40-year money to fund AI infrastructure with a technological horizon of maybe 5 to 7 years. Nobody knows what AI compute architecture looks like in 2035. Nobody. And they're issuing liabilities to 2066. We've seen this before. In 1999 and 2000, telecom companies issued 30-year bonds to fund fiber networks. Those networks went dark within 3 years. The bonds didn't mature for decades. The companies went bankrupt. And listen to Andy Jassy's framing on this raise. Once-in-a-lifetime opportunity. That's what telecom CEOs said at peak fiber in 1999. It's what coal executives said about the commodity supercycle peak in 2011. You'd expect once-in-a-lifetime opportunity to be the buy signal. Historically, it's the sell signal. Here's what you now have. 40-year liabilities funding 5-year technology. The underwriter telling clients to hedge against the paper they're selling, demand cut in half in 90 days, and Oracle showing you exactly what the exit looks like. Because the bond market moved before the stock did, and it's moving again right now. The number was $62 billion. Now you know why that's the bad news. The next signal to watch is Amazon's Q3 CapEx revision and how IG spreads move on the 2028 tranche. That's where this inflection either confirms or reverses. You now understand that the AI debt cycle is cracking. Bond demand cut in half in 90 days, the underwriter hedging its own deal, and a precedent from Oracle that already repriced 50%. But knowing the credit structure is breaking down isn't the same as knowing what price is actually doing right now, or when this story becomes tradable. Here's what understanding that story also doesn't give you. The truth about price. It gives you a narrative, and narratives matter. But price is what tells you whether the narrative is true or not. The measured move is a framework for knowing the direction of price. It tells you whether this narrative is being confirmed by price or not. If you act on a story like this without that framework, you could be right about everything you just heard and still be on the wrong side of the trade for days, weeks, or even months. That's the framework that I teach. The traders in my community don't get trapped by bearish narratives. They know where a trend fails, and until it does, until price confirms it, they will trade a bullish trend until it fails, even if it is against a bearish narrative. They have a framework for reading it themselves. That's the process I teach every day at eminiaddict.com.